The Ichimoku cloud is something we can use in trading as a trigger for buy and sell signals. A buy signal is presented when the default red line crosses above the default blue line and both lines and the price being above the cloud. The sell signal is presented if the red line crosses below the blue line while the price and both lines are found under the cloud. The Ichimoku cloud is a collection of technical indicators that show support and resistance levels and momentum and trend direction. It does this by taking multiple averages and plotting them on the chart. It also uses these figures to compute a cloud, which attempts to forecast where the price may find support or resistance in the future. The Ichimoku cloud was developed by Hosada, a Japanese journalist, and published in the 1960s. It provides more data points than the standard candlestick chart. While it seems complicated at first glance, those familiar with reading the charts often find it easy to understand with well-defined trading signals. The default Ichimoku settings are 9 for the conversion line, 26 for the baseline, and 52 for the leading span B. The Ichimoku cloud comprises 5 lines or calculations, 2 of which compose a cloud where the difference between the 2 lines is shaded in. The line includes a 9-period average, a 26-period average, an average of those 2 averages, and a 52-period average, as well as a lagging closing price line. The cloud is a crucial part of the indicator. When the price is below the cloud, the trend is down. When the price is above the cloud, the movement is up. The above trend signals are strengthened if the cloud is moving in the same direction as the price. For example, during an uptrend, the top of the cloud is moving up. Or during a downtrend, the bottom of the cloud is moving down. The most powerful Ichimoku signal is the Ichimoku uptrend cloud crossover signal, when the conversion line moves above the baseline, the blue and red lines. The closed candle is above the Ichimoku cloud.